begin by exploring the intriguing origins of the square root theory in financial markets. While the square of 9 is often mentioned as a square root calculator, its true discovery remains a mystery. However, its public application to trading stocks and commodities is widely attributed to the legendary W.D. Gann. Interestingly, Gann wasn't the only financial thinker to recognize the power of squares and square roots in predicting stock prices. In the early 1950s, William Dunigan introduced two trading systems, the thrust method and the one-way formula. Although these methods offered solid entry techniques, they lacked clear exit strategies. Dissatisfied with the risk-reward balance, Dunigan turned to and championed the square root theory, believing it held the key to better trading outcomes. Dunigan was so convinced of the square root theory's value that he called it the golden key to trading success. His advocacy didn't go unnoticed. Some economics and statistical journals of the time recognized his work. Over the years, references to the square root theory have appeared in various financial writings. For instance, Norman Fosbeck used it in his 1976 book, Stock Market Logic, to argue that low-priced stocks offer greater profit opportunities due to their trading range, which he linked to the square root principle. This idea resonated with many traders as it provided a mathematical explanation for price movements and volatility, making it a valuable tool for both new and experienced investors. Influence of the square root theory extends into modern investing. In 1983, William Proctor's book The Templeton Touch revealed that one of Templeton's 22 investing principles was that stock price fluctuations are proportional to the square root of the price. This concept remains relevant today, as square roots are fundamental to almost every volatility or option pricing formula. Theory suggests that stock prices, whether in the short or long term, tend to move in a square root relationship. Historical examples such as IBM's price movement from a low of 4.52 in 1962 to a high of 125.69 in 1999 illustrate how this mathematical relationship can be observed in real market data, reinforcing the enduring connection between square roots and stock prices. Welcome to a fascinating journey into the world of financial mathematics, where the square root theory and the legendary W.D. Gann Square of Nine intersect. For decades, traders and analysts have been captivated by the mysterious predictive power of these mathematical tools. But what exactly is the square root theory, and how does it connect to the square of 9? This video will break down the basics, explore the origins, and set the stage for understanding how these concepts can help decode market movements. Whether you're a seasoned trader or just curious about the math behind the markets, you're about to discover a new perspective on price analysis. Let's start by exploring the core ideas behind the square root theory and why it has intrigued so many. The square root theory proposes that price movements in financial markets often follow mathematical relationships based on square roots. This concept is vividly illustrated through real-world examples such as IBM's historical price data. For instance, IBM's monthly closing low of 4.52 in June 1962 and its high of 125.69 in July 1999 are closely related by the square of the sum of the square root of the low price plus 9. This isn't just a coincidence. Such patterns have been observed repeatedly, suggesting a deeper mathematical order in market behavior. By applying these calculations, traders can gain predictive insights into potential price highs and lows. Let's look at how these numbers play out and why they matter for anyone interested in market analysis. The square root theory is combined with the square of 9. Traders gain a powerful analytical edge. The square of 9, developed by W.D. Gann, is a spiral of numbers that helps identify key price levels and turning points. By integrating square root calculations with the square of 9, analysts can uncover patterns that might otherwise go unnoticed. This synergy provides a unique framework for understanding price action, offering actionable insights for decision-making. The result is a more nuanced approach to market analysis, where mathematical precision meets practical trading strategies. As we wrap up, remember that these tools are not just about numbers, they're about seeing the market from a new angle and making more informed choices.